The widely unexpected result of the referendum has generated huge uncertainty in financial market turbulence. We're now expecting the UK to enter a technical recession, that is 2 consecutive quarters of negative GDP growth, sometime between the second half of this year and the first half of 2017. Concurrently, unemployment, inflation and the government deficit are all set to rise. As a result of this, we've decided to downgrade the UK from a risk rating of DB2A to DB2C. While this is still low risk, the rating is very much subject to further downgrades, and to give this some context, while the UK was previously on a par with the US, its risk rating is now in the same range as Australia and Canada. The pound fell to a 31-year low against the US dollar in the immediate aftermath of the Brexit vote and could fall further. While this is positive for UK-based exporters, it means that purchasing imports for UK-based firms will now become more expensive. Internationally, the sharp slide in the pound bodes poorly for businesses selling to the UK, as their goods are now comparatively more expensive. However, products being produced in the UK will now be cheaper for foreign firms. On the global stock markets, UK companies based in the financial and construction sectors have borne the brunt of the impact of the Brexit vote, with sharp drops in their share prices. The spike in global risk aversion that has been triggered by the Brexit vote has prompted investors to shift into safe haven assets, such as the US dollar, the Japanese yen and gold, and to shift out of riskier emerging market assets. The sharp rise in the US dollar is bad news for those companies with high levels of dollar-denominated debt, as this will now become more expensive to service and pay back. Meanwhile, the sharp slide in commodity prices is negative for commodity firms as it weighs on their profits. As we are forecasting that the UK pound will depreciate further, companies should expect poorer payments performance from UK SMEs. From a supply chain perspective, remember that nothing changes for at least 2 years after Article 50 is invoked, so you have time to assess and plan properly. We advise companies to diversify their risk exposure by exploring opportunities in non-EU markets. Remember, it's vitally important to monitor events and developments over the coming months. Dun & Bradstreet can use the data and analytical tools at its disposal to help you face the future with confidence.